In this video, we're going to introduce the mechanics of taxation. We are going to make two examples. We are going to impose a tax on the consumer, and we are going to impose a tax on the producer and see where the differences are. So let us first have a look at the tax on the consumer. Here I have drawn a supply and demand graph with quantity on the horizontal axis and price on the vertical axis. And we also have a supply function and a demand function. Now, below here, I have made also a numerical example and assume that the demand function is written as Q is equal to 10 minus 2 times P, and the quantity supplied is equal to 2 times P minus 2. If you are going to solve this equation in the absence of any taxes, in the sense that you are setting the quantity demanded equal to the quantity supplied, and you are solving for P, then what you're getting is that P star is equal to 3 and Q star is equal to 4. So in the absence of any taxation on either the consumer or the producer, we have an equilibrium where the quantity is equal to 4 and the price is equal to 3. Okay, and note that since I will be using the same equation for both examples, for the consumer tax as well as the producer tax, I can also indicate this equilibrium here on the right-hand side with the quantity of 4 and the price of 3. Now, assume that we are imposing now a tax on the consumer. So you can think about this as an imaginary shift of the demand curve that is going to shift the demand to the left, like this. So here, let's call this D plus the tax. And how this works in terms of the equations is that now the price that the consumer pays, there is an additional tax on it. So it is the consumer pays P plus the tax. It should be noted here that now we are going to have a difference between the price that is paid by the consumer and the price that is received by the producer. So in this case, if we are going to solve for the equilibrium, now here assume that T is equal to 1, then what we are going to do is we can set QD equals to QS. And now remember that QD includes the tax term. And when you are solving this, you actually find that P is equal to $2.50, not $3.50, and Q is going to be equal to 3. So now here, note that we now have this new equilibrium, and let me use here a different color. So now we have a lower quantity of 3, or a new lower equilibrium quantity of 3. And we now have a wedge between the price that is received by the producer, that would be $2.50, and the consumer pays $2.50 plus T, which we assume is equal to 1. So the consumer actually pays $3.50. Okay. So here, so the difference between the two is equal to the tax. Now note that with this new scenario, we now have a new consumer surplus and a new producer surplus. Okay, so in the sense that, let me just extend those lines. So now we have the new consumer surplus is the area up here. The producer surplus is the area here. And then we also have the revenue for the government, which is this area here. Okay, and now we have the consumer surplus, and we have the producer surplus. Then here we have the government revenue. Which note that it is the tax, the amount of the tax, $1, times the new quantity traded, which is $3, which is a quantity of 3, okay? But note that compared to the previous situation, we now also have a deadweight loss, okay? So previously, without the tax, societal welfare was the producer surplus, as well as the consumer surplus, okay? And now the producer surplus, the consumer surplus are small. We do have some government revenue. So here this is simply a transfer of wealth from one entity to the other. And now here you can see that the taxation in a perfectly competitive market leads to a welfare loss, okay? So here this is marked with the DWL, so deadweight loss. And that is if we are doing the tax on the consumer. Now let us move to a slightly different example, or a different tax, where we are actually taxing the producer here. Okay? So you can think about the producer tax as shifting the supply curve upwards. So here let's call this S plus the tax. And then we can go through the same calculations again, where you can set the quantity demanded equal to the quantity supplied, okay? But now note, as opposed to the tax on the consumer, the tax is now levied at the producer level, okay? So when you solve this, you again get a new equilibrium, where you have the new P star, which is going to be equal to 350, and Q star is equal to 3, okay, a quantity of 3. And here again, very much like with the tax on the consumer, you now have for the producer, you now have a wedge between what the consumer pays and what the producer receives. Now in this case, we have the new quantity is 3, and you should already note that the quantity is equal to the tax on the consumer. Okay, so the quantity exchanged in the market hasn't changed. And of course, got to say that here we are assuming that the tax is equal to 1 as well, similar to here. Actually, let's make this a small t. And then you see that we are arriving at the same quantity, whether we are taxing the consumer or the producer. Then when you are actually looking at the prices, then you see that the consumer pays, again, $3.50, but the producer, since the producer has to pay the tax of $1, the producer only receives $2.50. Okay? You see that when you're comparing the tax on the consumer to the tax on the producer, that there is not any difference. So it doesn't matter of where you levy the tax, on who you levy the tax, that the resulting market outcome is actually identical. In the sense that you again have the consumer surplus up here, okay, which is identical to the situation on the when you have the tax on the consumer. You have the producer surplus, and then again you're going to have the government revenue, which is the red box here, okay? Which again is the difference in the prices that is equal to the tax amount of $1 times the quantity exchanged in the market. So here we have $3 and $3 in government revenue. And as before, we also have a deadweight loss, okay? The deadweight loss is this little triangle here. Okay, DWL. Okay, so here the point that you have to understand is that it doesn't matter of whether the tax is imposed on the consumer or the producer, that the resulting market outcome is going to be identical. Now, there is also another, probably more important aspect of this graph, and that is who is actually paying the tax. So think about, very often you hear that if you have, say, a tax on the producer, here we have a tax of $1 on the producer for this particular good, then very often you hear that if you are imposing a tax of $1, or if you're imposing any tax per unit tax on a producer, that the producer is simply going to shift the burden of the tax, the entire dollar amount, to the consumer, okay? And you see here in both graphs that this is actually not what is occurring. So we always have, or in most cases, in the majority of cases, we have a downward sloping demand function. And what this means is that the producer cannot simply shift the entire burden of the tax to the consumer, okay? In the sense that despite the fact that we have a $1 tax, the price for the consumer only increases by 50 cents, okay? And that the other 50 cents, or the remaining 50 cents, is actually covered by the producer, okay? So the producer isn't getting, so remember that without any tax, the producer gets $3. So it isn't the case that the producer still gets $3 and the consumer simply pays $4, okay? That is not possible since we have this downward sloping, demand function. So this introduces the one part of the mechanics of taxation. Note that the welfare loss for taxation is only occurring if we are imposing a tax in a perfectly competitive market. We will see later on that if you are imposing a tax on a producer, for example, in a market that is suffering from an imperfection, that you can actually restore the efficiency, okay? Now, let us look a little bit closer of who is actually impacted by the tax here. Okay, so here we said this is by how this problem is set up, that the tax is the burden of the tax is equally shared 50-50 by the producer and the consumer. Now let us have a look at a situation where this burden is different. Now here, in this case, I have drawn two supply and demand functions with, again, quantity on the horizontal axis and price on the vertical axis. But here, the demand functions are different in the sense that here you have a very inelastic demand function in the sense that it is very steep. So what this means is that if you are changing the price by quite a lot, this does not translate into large changes in the quantity demanded, okay? Then here on the other side, I have a very elastic demand function that is very flat, if you will. And that basically leads to, if there's even small changes in the price, then that has large effects on the quantity demanded, okay? That's why we have an elastic demand function. And here we have an inelastic demand function. Now, for both cases, assume that both markets are initially in equilibrium. So we have Q star and P star on both sides. And that now we are actually imposing a tax on the producer in both markets, okay? So when we are imposing a tax on the producer, then this results in, think about as a shift in the supply function. and assume that the tax now shifts the supply function like this. And assume that here this is in both cases, that we have this new supply function plus the tax. And then now let us look of how do those market equilibria differ depending on whether the demand function is inelastic or elastic. So here in this case you can see that the new market equilibrium, and let's call this QT and PT. Then now in the case where the demand function is very inelastic, that the burden of the tax is actually imposed on the consumer here. Okay, so the price under the tax for the consumer increases much stronger than decrease for the producer, in the sense that, suppose here in this case, you can think that if there's a $1 tax, then the price for the consumer may increase by, say, 80 cents, whereas the price for the producer only decreases by 20 cents. Okay? Now, if you want to have a slightly more extreme example, you can think about a situation where you have, let's say, a demand function that is almost vertical, okay? And you have the supply function, and you have the demand. So you can think this about some extremely life-saving good, where the demand is constant no matter what the price is, okay? Then you can see that if you are imposing a tax here on the supplier or on the producer, so here S plus tax, then in this case you can see that the entire burden is based on the consumer. Okay, so here this would be the only situation where a producer can shift the burden of the tax to the producer, to the consumer. Okay, otherwise that's not possible. Now, what happens if we actually have the elastic demand? Okay, so here the situation is in favor of for the consumer, in the sense that we are having this new market equilibrium. Okay, and you see that in the case of an inelastic demand, the case of an elastic demand, the price for the consumer only increases by a little bit. So here we may have a situation where the if you assume a $1 tax, where the price for the consumer is only increasing by 30 cents, but that the price received by the consumer, received by the producer, is actually decreasing by 70 cents. Okay, so the elasticity of the demand function determines of who is most impacted by the tax. In the case of an inelastic demand, it is the consumer who suffers, if you will, who suffers the most from the tax. Whereas in the case of an elastic demand function, it is the producer who bears the burden. Only in the case where we have a supply function that is perfectly inelastic is the producer able to shift the entire burden of the tax to the consumer.